Hey everybody, wanted to do a nice update video. I hope you're having a great weekend. Another crazy week again. The USAR was insane. First of all, of course, everything is for educational purposes only. Your trade, your responsibility. And if you're okay with that, let's keep going. Let's talk about a couple things. It's happening. We'll see what I'm talking about. We'll talk trends, Economist blues, the state of the market, just a little bit on things. I'll try to go through as quickly as I can. Quick Micron and excited options pricing. What does it mean? So we'll take just a little closer look at option pricing right now, just in general, because we're seeing similar things across the board. The USAR Turbo, which is a trade that we don't really do in leaps, but I got excited about it. And then small is big again, which, we could put up higher here actually. So just quickly, we can see I put out a tweet this morning, and it was an excerpt from Torsten Slok just saying, economists, we need to take a really good look at how we look at things, because we're getting things wrong all the time. We're getting things wrong. And I think that's always been the case. I mean, economists are kind of wrong. Just, you can pretty much expect them to be wrong a lot of the time. Kind of like how you can expect politicians to lie. It just sort of comes with the territory. You can see here the consensus has been wrong since January, but this isn't anything new, right? Real GDP, they always get it wrong. Everyone gets it wrong, and maybe that's a part of being in an era of money printing and constant stimulus, and the people in charge, they own a lot of assets and stocks and things like that, and we know they love to trade stocks and they do well on it, Nancy Pelosi and company. So they don't want to lose their net worth either. So there's probably self-interest here, without a doubt, and so we want to keep kicking the can down the road. And so this is the world we're in, right? It's to juice everything pretty much all the time. Don't let anything sort of, economies aren't really expected to take their medicine like they maybe were in the 70s and 80s. And we kind of went, oh, well, we're going to have a little rough patch here to get through it. That stuff isn't happening anymore. So we can see just, really low. We saw a 3.8 GDP number come out. We've seen good retail sales. Of course, jobs are waning, right? So there are problems out there. We can see that right here. U.S. job openings, look at them come down as the S&P goes up. And so we can see people aren't hiring. A lot of companies are kind of going, hold on, let's figure out how we're going to put this AI to use, which is good for us as investors in AI, but of course not as good for graduates and people looking for jobs. So let's take a look. We can see forward PE ratios. We can see the big caps starting to get up there a little bit. So you don't want to bet against them, because they are creating this new world, and they certainly have the ability to pivot into all manner of areas that are going to benefit from this new world. You just can really never count them out. But in my view, it's going to be a little bit roaring 20s like. So maybe the MAG, as I said a couple of weeks, I said maybe MAG kind of calms down a little bit at this point, and we start to see a broadening. And that's exactly what we saw. We talked about IWM, we put on a trade, and then now it's making all-time highs. So here we are. What I talked about, I think it was 2 weeks ago, I did a video for you guys, and here we are. I'm just going to show you these charts again. This is profits for big cap companies, for mid cap companies in blue, and then small cap. Look how they're curling up here. I said, keep an eye on these. This is what is starting to be very, very interesting. And I'll repeat it again for those maybe who didn't watch. This is kind of like, think of the .com as creating this sort of platform for everybody to benefit from all the things that the internet gave us, social media, et cetera, e-commerce, smartphones, blah, blah, blah. What's been created over the last 10 years is really that foundational element, that physical element that is going to enable AI inference to spread everywhere. So here we are with the potential for this now to spread throughout the economy via ChatGPT, all these agents that people are be creating. We're going to see innovation on a level we just can't even imagine. It's just going to be mind-blowing at this point, seeing what people come up with to make our lives easier, to find productivity, to find efficiencies. It's just going to happen. There will be some downsides probably through employment. And if you're just sitting around waiting for this thing to happen, you need to get off your feet, get off your butt, and get out there and realize that the world is changing quickly. So unfortunately, that's the advice that I'd be giving to young people, is take the bull by the horns now. It's maybe you don't know exactly how, but you got to figure it out. And we are clearly just blowing past seasonality. It does not matter. Now I'm going to show you some stuff in a moment that may lead us to believe that maybe we're a little bit bit on the frothy side. But again, here is the market. Here are valuations in the big caps nearing those levels of the .com. Now, you can't say that broadly speaking. In fact, I'd say almost, regular kind of industry areas are probably trading more expensive than Nvidia's and Google's and things like that. Like you look at Walmart, you look at some of these, regular Joe kinds of companies, and they're very, very expensive. So some of that is in play here. So I wouldn't be getting negative on an Nvidia per se, and Micron, which we've been in, which I'd love for the valuation, right? I said out of AVGO and into Micron, and AVGO has done nothing, and Micron's had a good run. So sometimes valuations do matter, and sometimes we're going to get it right, and sometimes we're going to get it wrong. But in my view, there are interesting things going on out there. So we'll talk about Micron in a moment. So let's get to our next topic. Okay, so let's take a look at Micron here. Yeah, here we are. We had that really nice run, and then we paused a little bit after the earnings, 170. We came down to the 150s. I added more personally. I just kept adding because of the valuation and the fact that these guys are in an area that is really, really, really important. So, and then also we've got this whole government, America, get behind American companies. I think we benefit from that as well. And it's in an area that I think people are underrating in a way, which is memory. I'm a big fan of that sort of whole memory space. I mean, it is incredibly crucial to everything we're seeing. Okay, so we're looking at 9-month volatility right now. We can get rid of historical. Historical is not that useful. Somebody mentioned in the Discord today, and it's long-term historical is just sort of it lags, right? It's looking at things on such a long period. It's like kind of like a 200-day moving average. It's not really giving you much positive immediate information. It's giving you very long-term information. I just don't find it very useful for historical. Now, when you look at implied, well, that's the cost of options right now. So it is very useful. We know exactly what it means. And let's take a look at we see the rank and percentile of these things going up. Look at this. So this is really what's happened is, a little horn tooting here, but I said over the last few months, I said, listen, the options are too cheap given what's going on in the world. They're too cheap given the potential for a melt up, the potential for AI to change so many things, the potential for things to break in some ways, for jobs to get affected, et cetera. So there's lots of things, and this was just too cheap. It was underpricing things, and I said you could win three ways. So you could win with your three Greeks, which is one is delta, that's your direction. So if you own calls, you benefit as the stock goes up. Number two, you benefit from Vega, right? So Vega is your exposure to implied volatility rising. Or dropping, in this case, rising, because when option prices are low, certainly they can get lower. But when you're looking forward, as I have been, to what might be happening in the world, I said these are too cheap. And then the third way, you've probably heard me say this in a number of videos, is the upside skew. So that call skew getting excitable. Well, what's happened over the last few weeks is that's exactly what we're seeing everywhere. We're seeing people get excited as the market makes new highs, and people are starting to recognize, whether it's option markets, it's the collective sentiment out there. We don't always know where it's coming from, but the market is now saying, "Oh my gosh, this is a kind of situation that could blow up to the upside, to the downside. We could get a mania like 1999, like 2021. We don't really know where to price things. That's what I've been saying on Samantha's show. I've been saying, well, how do you even know how to price this market? We don't know how AI plays out, how inference plays out. We don't know who's going to figure it out, who's not going to figure it out. How do we know where the benefits are going to be, as well as the disruption as well? We know there's disruption. Software took it on the chin again in some areas because of the potential for AI to disrupt. So how can options be at their absolute cheapest in the last few years? It didn't make any sense. But now what we have is this Micron position. So even if you look, the amazing thing to me is that we're actually seeing this vol blow up. When I say vol, I mean option pricing. You're seeing vol blow up across the board. This is very unusual. Usually you see option pricing move, the tail that is getting wagged is in the front of the curve, right? It's the 30 days, it's the 1 week, it's the 2 month, it's the 3 month, maybe it's the 6 month if you're lucky. To see long-term options do something like this is really, really something. So on our leaps, we are making, I did the calculation on the Micron position. I looked at one of my positions in my account. I'm like, I'm up $17,000 on like not even a very big position. And Micron hasn't even gone up that much. Yeah, it's had a little bit of a move since 160. volatility. And I did the calculation on where that Vega exposure is, right? So how much, I figured out, well, how much have I made from not just the delta, which is being right on these calls, but how much have I made from implied volatility actually rising? And it was over a third, right? It was about a third, about 35%. And so that's why I started to sell some of them, because I've made money where I didn't think I would make it quite as quickly. And even though I'm still very positive on the stock, we do have a market that is a little bit frothy. And I know you could say that, almost every week now. I don't think Micron's expensive at all. I think it's still cheap. But, at this point, I've made a good chunk of cash just on this sort of secondary benefit, even though I kind of thought it would happen. It's happened, and it's a nice added benefit. So I'd like to monetize that, because at this point, what can happen? Well, if the stock market calms down a little bit, and we don't know if that will happen, but if the stock market calms down, we may see this come back down to reality a little bit, maybe down to sort of, a better resting heart rate of, maybe like 47, 48, somewhere around there. 44 is going to be too cheap. I don't think it'll get back down there, but you never know. Going into Christmas and all that, anything can happen, but that's a long ways from now. So it could pull back maybe 3, 4, 5 points. And so I don't want to lose that, right? So I've made on that one position where I'm up $17,000, I've probably made about 6 of it on Vega, on option pricing going up, and the rest on Delta, and of course a little bit of skew there, which is just similar to Vega, right? So the skew is kicked up, the option pricing is kicked up. So I'm going to take some of that off the table, because it could calm down. This is really kind of an exceptional move. In fact, to give you an idea of how exceptional this is, the last time we saw a move like that was to the downside, not to the upside. It was to the downside when the market was crashing and getting crushed, and they were selling these things off very, very hard. Micron went from, I don't know what it was, 115 to 70. That's when the vol went up. Well, guess what's different about this picture? It's happening as the stock goes up. This is a new paradigm, and it's something that, even though we may be selling out of some positions, we want to be looking for the next opportunity at some point. There's going to be a lull at some point, and in my view, it's going to be an opportunity to probably add exposure to names that people are just going to, kind of maybe panic sell at some point. And that will be our opportunity to perhaps reload a little bit. So when the time comes, we will look at doing things like that. But this is really, really an interesting situation. And, I'm a vol guy, so I'm looking at this going, wow, these are totally different environments, yet we are seeing this incredible jump up in option pricing. So I think that's very interesting. So I wrote on the agenda, I said, well, what does it all mean, right? What does it all mean? Well, look, it all means that we're starting to get a reaction out of markets, not just in the market going up. We're starting to get a reaction from further sentiment indicators that I think are very important. That's kind of how all my programs and things, all those things are sort of based around understanding more than just what most people sort of look at, which is, understanding people, because people and behavior don't really change that much. And we want to understand that. So what does this mean? When you see the IV percentile go from 0, right, from 6, would it go from 4 to 76 in pretty short order? People are getting excited again, right? That is a sign that things are getting a little bit frothier right now. So when I see this percentile darn near the April highs, and we've had a run up, well, that's kind of telling you that we are, and this is sort of why I've been I'll do a video at some point on a conversation I've had on Twitter, which was about doing cover calls. And I said, they don't really make sense a lot of the time. And of course, everyone's like, swearing at me and calling me names and this and that, and they don't get that this is actually true. It's statistically, even though I sold, even though I managed $750 million worth of cover call funds and did this for a living, I did it very selectively. I did it strategically, because if you just do it all the time, you're going to give up performance. There's statistically, that's pretty much 99% you're going to give up performance. Now, you may not care, you're getting this cash flow, and that's fine. And it depends on many, many things, and demographics and your age and all that, your age, and that's fine. I'm not saying it's the wrong thing to do, but I try to do it more strategically. And then even when I do it, I get caught. I made a few good trades on hood, and then now I've been caught with my pants down a little bit as it's continued to go up. So that's fine. I've made like 400% on my leaps, and I'll give up a little bit on the income portion of it. I'll probably net break even. Well, no, I'll do a little worse than break even on the specifically on the income portion. But you guys see the position. It's in the portfolio. But what it does do is it allows me to actually continue to participate. So that's one nice thing about covered calls. You sort of look at it and you go, well, I could have just sold out my position and then it's case closed. I don't participate anymore unless I rehook some sort of different kind of structure, call spread, something like that. But it kind of keeps you involved and it keeps you in the game. So a lot of the time you ultimately will get called away, but you'll do better than if you had probably sold when you first had the inkling to kind of get out of the position. So there are some sort of secondary benefits that you can kind of, you can kind of speak to at times when you've done this long enough, you think of things like that. So here we are, Amazon, boom, another one, not as dramatic as Micron, because perhaps Amazon doesn't have that explosive potential that Micron has at this point. And so, but still, look at this big move. So I'm not going to go through all the different stocks, but this is what we're seeing everywhere. And so when I say, what does it mean? Well, it means that we are now starting to recognize the frothiness, the potential for more of a melt up potentially. And that means option pricing starts to notice that. And it says, oh, okay, well, we better start to price in this possibility. Does it mean it'll continue? Well, it's very difficult to get negative into the final couple of months of the year. They're the strongest period of the year. Going into Christmas, it is just deadly to be short a strong market, a strong theme, a strong story, AI, et cetera, and basically you're short the fact that so many people are underweight, managers are eternally, and because of the charts I showed you earlier, most of them are sort of looking at these prognostications by economists who have no clue really what's going on. They base their decisions on old ways of doing things. I'm not saying it's all wrong, but clearly something is not gelling in terms of what they look at and reality right now, and you can see it play out, right? It's stock, the stock market is no longer Main Street as much as it used to be, and we're going to have to grapple with the consequences of a boom that involves perhaps fewer jobs. It's very unusual, right? Historically, you create companies, you manufacture, you build, you need people. You don't need as many people now. This is a very, very big change because of AI. It's not all that positive for those who are going to get blindsided by it. But this is what we're seeing out there. So let me tell you quickly, I don't want this to go forever, but I want to tell you about the turbo trade. USAR, beautiful. What a move. We got into this position right around here, and then we closed strong. And then it's funny. I had a call spread in another account, and I looked at it and I was like, I wanted to sell it here that day. Just because I'd been waiting so long on it. And I was actually out money on it because that upside call skew had blown out. So you see how that call skew can really affect you, right? The one I was long was doing well, but the one I was short was like pushing up. So it was like, man, I'm not even making money on this delta long position. So this is sort of the fun with options that you can have sometimes. So I waited, and then the call skew kind of collapsed a little bit, and then I made money. So I wasn't making money here, and then I made a whole bunch of money here because not only did it jump, but it actually the curve sort of did what I needed it to do. So this is the world of multi-dimensional options. So here we are. A nice trade. I got out of some personal positions. I'm just going to wait, and then we put this nice little turbo on. So I want to show you guys this trade because it's not a typical trade that we do. But I was excited about it, and I feel like this is one of the unique situations. We should have done one of these on Intel around 30 after it jumped, and I'm kind of really irritated with myself that we didn't do that, because the perfect kind of stock where you go, okay, look, there's a bit of a floor in this theme, right? There's a bit of a floor. Intel wasn't going back to 22 because of what's going on. It was an opportunity to do just this kind of trade, but I will say that we're going to do it on this one for the same sort of reasoning, which is you're going to sell that 17 put at 280, or wherever it was trading at the time. I think I got 290 for it. I think I got 290 for this one. So you sell that 17 put at 290. So what does that mean when you do something like that? Well, when you sell a put, a cash secured put, you are obligated to buy the stock at 17. That's the strike price. You're saying, I agree. I'm going to sell this put to whoever wants it. Maybe they want to buy it for protection, whatever the reason is. I'm going to sell them that put. And I'm going to receive $2.90 for it. So where's my break even if the stock goes down? Well, it's 17 minus the 290, which is 14.10. So I will effectively own this stock at 14.10 if it gets down here by March of next year. Am I okay with owning USAR at 14, given what's going on? This is part of my non-negotiable sort of basket. Yeah, I would be okay with that. Now, it's not Microsoft, so it's not something I would put, 20% of my net worth in, but this is an interesting play. So in this case, though, we're going to use this. So we're going to buy that 27, if you haven't already done it, but if you could buy the 27.30, it's actually a 39 that we did. A 27.39 call spread, which I did for 245. So I put this whole thing on for a 45-cent credit, because the call spread I'm purchasing, actually that call spread isn't really very expensive. I'm actually sort of a little bit surprised that it doesn't seem to price that badly. And I think because that upside call skew is so steep, we're buying a 27, which is a high implied volatility, 112, but we're selling the 39 for a 118.5. So you're getting a nice differential there of volatility. So it's getting you just a little bit of extra juice on that 39, which makes this price a little better. This probably should price around 3 or 350 or 325. So it's a little better because of that pricing. So beautiful advantage to us. So we're selling this 17 put for 290. We're buying the 27.39 call spread for 245. So net, we are putting this on for a net credit of 45 cents. So let's say USAR stays between 17 and 27 over the next few months until March expiry. Well, nothing's going to happen, right? Because we're going to be benefiting from the erosion of this put, and we are going to be losing money from the erosion of this call spread. So they're going to kind of offset each other, which is why I like the turbo. At some point, I'm gonna bring a kind of a turbo approach to all of you guys if you're interested. I have some really cool things in the works, by the way. And one of the nice things is it's a little bit volatility agnostic. So the nice thing is you don't have to care so much about being right away, right? So it's kind of what I say with leaps is you give yourself the ability to not have to be right away. You can be wrong. You can step back. You can look at the big picture. You can not fret about, something trading at 112 volatility, which is bloody high. Because you're offsetting it with a finance that is also bloody high, right? So this all kind of balances out in a sense. Now, it's a delta long strategy. This strategy requires the stock to go up. So if you put this on and USAR goes down to $20, well, you're going to be out money mark to market. Now, you know that you're not going to be out money until this drops below 16.55, right? Because we're using some of this credit to pay for the upside, our break even is no longer 14.10. It's now the benefit of the difference between these two, which is 45 cents, right? So if I deduct 45 cents now from 17, I get 16.55. So now 16.55 is where I technically need to own USAR on the way down. And I'm okay with that. It wasn't that much lower recently, a little bit. It was in the 14s at one point, not long ago. But I'm okay given what's happening out there and the fact that, this is one of those non-negotiable areas that I think, at first I thought, well, maybe it's just a rumor, but it's more than a rumor. The CEO confirmed it. So this thing is in play. We're not going to have enough rare earths, and we rely on China for pretty much all of them. So this is absolutely a critical input at the moment until we don't need these kinds of things. But right now for EVs and phones and electronics and all kinds of things, data centers, I mean, this is like, what, I mean, I think copper is interesting too. So one thing I will say is that I mentioned in my last video is that we want to start to look at other kinds of things, right? And so we got into IWM. I want to continue to look at broadening. I like the ARKG. So I like biotech. You can do XBI for that. I think we want to look at other kinds of infrastructure plays as well. I mean, power's good. I mean, utilities are okay because of their exposure to infrastructure. So I believe there's going to be a very big boom in infrastructure that's going to continue because of this AI build out. So I think we want exposure to those kinds of things. So we're going to kind of broaden out a little bit and sort of watch the consumer, watch spending. It seems to be fine. Maybe we can even kind of broaden out into even some consumer discretionary things like that. But very different from what we've been looking at. We're not abandoning AI by any means because it is still full speed ahead. But it is a market where I do believe we can get a little bit of broadening. So that's it. I'll leave the portfolio for another video. I hope you guys enjoyed this, and we'll see you guys in the chat. And have a wonderful rest of the weekend. And again, thanks for your support. Thanks for being in Leaps Trader. I really appreciate it, and we'll see you soon.